Hi, welcome back. In this second part video, I just want to take you through a framework for detecting financial statement fraud and to talk about the fraud detection rectangle. Let me start with 3 ideas from this framework. The first idea, you as an auditor or as a fraud investigator need to pay a lot of attention to strategic reasoning. And when we talk about strategic reasoning, we're talking about anticipating the fraud methods. In other words, the type of fraud schemes that are likely to be going on in your assignment. Now, this is a game here because the fraudster is going to try and think, all right, what type of tests am I going to undertake as a fraud investigator or an auditor to prevent the fraudster from their fraudulent scheme? And that's where we go to the tests for detection. And then the fraudster is going to think, all right, if the auditor is going to detect here and this type, they're going to come on this month and that month. Then I'm going to change the type of my fraud scheme to conceal from the auditor's tests. And so then that game goes back and the fraudster is going to conceal their efforts or the nature of their fraud scheme from the auditor's test, from the fraud investigator's likelihood tests. And so this is where you, as an auditor, as a fraud investigator, need to go to the next degree and modify your tests. So this is a game of cat and mouse, right? You start with questioning, what is the likely test that you will go through to detect such scheme? And then you assume, then they will change this scheme because they will try and predict what tests you're going to undertake. And then you've got to say, okay, what type of scheme will they change to, assuming that they know what tests you're going to take, and then you've got to modify your tests again. All right. And this is a cat and mouse that you need to think of. Okay, what tests did I do last year? I might need to do other tests this year. That's the exact approach that you need to take when you come to audit a company, and maybe when you come to investigate a fraud as a fraud investigator. All right, that's the first thing. The second thing is there are these usual suspects here of enhanced detection techniques, which we have talked about a little bit under fraud prevention, a whistleblower program. You've got fraud detection, continuous monitoring, advanced analytical procedures, and cross-functional team reviews, which again is under fraud detection. These are usual suspects that we have covered in earlier chapters in the textbook. Number 3, then that leaves us with undertaking financial statement analysis and looking at non-financial performance measures. And this is basically the content of chapter 12, chapter 13, where we're going to teach you what to look for in financial statements, how to uncover red flags in financial statements. Wow. Let's go to the fraud exposure rectangle and finish this part. As you can see, the fraud exposure rectangle has 4 parts. And as you can imagine, each of those parts breaks off into many smaller parts. There's the management and directors. There is the relationship with others. There's the organization and industry. And finally, the financial results and operating characteristics. These are all areas in which you can investigate as a fraud investigator to look for red flags in financial statement fraud. Broadening out these 4 areas, notice that management and the board is the first thing you need to really look at, because you really need to understand their motivations, as we talked about earlier in the textbook. And they are also very influential in their decisions that they make. Do they have a tone at the top? You could talk to employees or understand from people who have worked at that organization before to learn about the culture. And that can give you some sense of where the management board are with respect to their ethics, their integrity, and the likelihood that they would do financial statement fraud. Next, you have relationships with others. And every one of these relationships you need to consider. And auditors, financial institutions, lawyers, and so forth. After that, you need to consider the organization and industry. And this was a big one for Enron because they created these special purpose vehicles for undertaking off-balance sheet transactions that enabled their financial statements to look very, very rosy and signaling to the investment community that they are bigger and stronger than what they really are. All right. So you need to find out what other vehicles, companies is that organization associated with. Do they have financial relationships with them? Are they given loans to those companies? Are they selling products to those companies? And so forth. And so there's a lot of areas that you can uncover, a lot of red flags that you can uncover looking at the organization and industry context of the firm that you are investigating. Finally, you have the financial results and operating characteristics. And we keep on coming back to what we're going to look at in Chapter 12 and Chapter 13. And that is looking for red flags in the financial statements. Wow. I just want to pull out two individuals that relationships are really critical to have for an organization. The first one is the relationship with the auditor-auditee relationship, because the termination often is caused by the failure of the client to pay, or a disagreement over the financial statements, or a suspected fraud or other problems by the auditor. And under the Sarbanes-Oxley regulations, when auditors leave, then information needs to be given to the SEC. Information needs to be relayed to the regulators. On the other hand, the relationship with lawyers are different. There is no regulation requiring lawyers to report to the regulators of any of these instances for why they may have been terminated. On the other hand, lawyers are usually advocates for their clients and will often follow and support their clients until it is obvious that fraud has occurred. And they may not know or be able to understand the fraud as early as the auditors. So keep these two key people in mind when you're looking at the company relationships with other parties. The last part of this video, I want to briefly go through the critical questions about financial statement relationships and operating results. These are questions that we will examine in the coming learning modules. Stuff like, are the account balances realistic? Have there been significant changes in the nature of the organization's revenues? And I've already given you an example of Woolworths through horizontal analysis. Are significant transactions made near the end of the period? And you'll learn more about that in Chapter 12 and Chapter 13. Does the entity show an inability to generate cash flows? It's one thing to generate accounts receivable, but until those accounts receivable are converted into cash, it's not real revenue. So that's why we always focus on the ability of a company to generate cash flows. Another thing is, are the reported assets, liabilities, revenues and expenses based on significant estimates that involve unusually subjective judgments and uncertainties? And increasingly today, we are asking, or regulators are asking organizations to make statements about their transition and climate-related risk. Is the organization in a position to transition into the future, given where the industry is going, or given how climate patterns are changing, earthquake, rain, hail, fires, etc. How's that going to affect the sales revenue stream of the products and services that the organization is going to sell in the future? This is what we mean by transition and climate-related risks. Wow. And just more risk. Does the growth or profitability appear rapid, especially compared with other companies in the industry? What about the effect of interest rates? Again, interest rate risk, given how leveraged the company is. And what about the threat of imminent bankruptcy? Can the organization pay its debtors when they come due? So lots of questions here. And we will revisit some of these questions as we go through the financial statements over the coming learning modules. Let's finish up with a few more questions. Again, does the organization have difficulty in collecting receivables? And what about the footnotes and the non-financial performance indicators that are talked about in the notes to the accounts? These are minimum requirements as an auditor to look for red flags about the ongoing concern of the organization that they are auditing. Wow. So let's just finish up with these questions and bring you back to the end of this part where I said financial statement fraud is the big one. And I showed you through many, many instances of frauds, the big 36 frauds that have happened in the last half century. Okay. A lot of them were accounting related frauds. That's good for the accounting profession in many ways, especially if you're going to become a fraud examiner or an auditor. And so I talked about the problem of financial statement fraud, professional skepticism. I talked about the fraud exposure rectangle and critical questions about financial statement relationships. Remember, we have gone past your act of being a fraud investigator, of employee asset fraud, which is against the organization. We're now looking at fraudulent acts that are on behalf of the organization, and in most cases are committed by senior management. And that makes your job as a fraud investigator so much more difficult, because the tools of fraud prevention, the tools of fraud detection are less likely to reveal the financial statement fraud that has occurred or that is alleged to have occurred. This is O'Connor. Welcome to this area of financial statement fraud. See you in the class. Bye for now.